Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at AST SpaceMobile.
If you find our talks useful, please consider subscribe, like, and comment underneath, because today we are looking at a company attempting something that, well, it kind of defies gravity in more ways than one.
It really does. I mean, it's a massive undertaking.
Right. Imagine you're trying to build a skyscraper. Usually, you start with a massive concrete foundation in the dirt, and you just build up floor by floor.
Yeah, the normal, predictable way.
Exactly. It's visible, it's steady. But AST SpaceMobile is basically trying to build a skyscraper starting from the roof down.
That is a great way to put it.
They are essentially hanging steel beams in orbit like 300 miles above the Earth, just hoping to successfully connect them to the ground later. That is the gravity-defying feat we're unpacking today.
And attempting to bypass the physical constraints of terrestrial infrastructure. That is exactly what playing in the commercial space sector feels like right now. It looks completely impossible until, those pillars finally connect.
Yeah.
But before we get into the actual mechanics of how they do that, we want to mention a really useful chart tool for the investors and traders following along.
Oh, yeah, definitely.
If you're looking for help reading trading charts more clearly, you should check out VIP Algos through the affiliate link below in the description. VIP Algos is a TradingView indicator suite.
And it's super visual, right?
Yeah, exactly. It overlays these visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even specific take profit and stop loss planning areas directly onto your charts. You can use it across multiple markets, so stocks, forex, crypto, gold, indices, whatever you're looking at.
But we always have to remind everyone.
Yes, absolutely. Keep in mind, VIP Algos is strictly an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it guarantees absolutely zero profits. Trading involves substantial risk, so always manage your downside and, do your own research. And again, that's an affiliate link, meaning we may earn a commission if you use it at no extra cost to you.
Right. And a tool like that is particularly relevant for today's talk because when a stock swings as wildly as AST SpaceMobile has, dropping nearly 50% from its 52-week high of $133.86 down into the mid-60s, it is incredibly easy for you, the investor, to just get completely lost in all that day-to-day noise.
Oh, for sure. You see a sea of red on your screen and you just panic.
Exactly. But a massive drop isn't inherently a disaster. So we really need to figure out, is this a healthy, necessary market correction for a company that's just finding its footing? Or is it a giant flashing warning sign?
Right.
So let's establish the wealth building context here. How should someone actually view a company trying to beam cellular service from space directly to our pockets?
Well, first off, you have to fundamentally adjust your time horizon. AST SpaceMobile is not a quick intraday swing trade.
No, definitely not.
This is a category-defining, long-duration opportunity in global telecom infrastructure. If you think about the legacy telecom industry, just consider how much capital has been spent over the last, 50 years just putting metal cell towers on top of mountains.
And battling local zoning laws, dealing with property rights?
Exactly. Physically burying fiber optic cables underneath oceans and highways. The sheer physical friction of building out that network is staggering.
Yeah.
AST SpaceMobile is attempting to bypass all of that terrestrial friction by simply putting the cell tower in low Earth orbit.
Which means they aren't just disrupting how we make a phone call, they are attempting to rewrite the actual physical geography of the internet.
Yeah, it's a huge swing.
But let's ground that excitement for a second, because while the concept of a space-based cell tower is revolutionary, the investment reality here is highly speculative. This is what you call a classic binary commercialization play.
Meaning it either works globally at a massive scale,
or it fails spectacularly.
Yeah.
Yeah, there is very little middle ground here.
Right.
So if you are managing a portfolio, you have to understand this is not a defensive income strategy. You are not buying the stock to collect a safe, quarterly dividend to fund your retirement.
Definitely not.
It requires immense patience and really only fits a high-risk, high-reward portfolio seeking what we call convex optionality.
And that concept, convex optionality, is crucial here. It essentially means the potential upside is vastly disproportionate to your initial investment. The ceiling is extraordinarily high if they pull this off.
Right.
But you have to accept the very real risk that the floor is zero. You are placing a thesis-driven bet on the successful deployment of a completely new generation of network architecture.
But a revolutionary idea doesn't mean anything if the math doesn't work. And right now, their math is pulling in two completely opposite, almost dizzying direction.
It's wild to look at.
Let's look at the actual fundamentals driving this business. On a trailing 12-month basis, meaning we're looking at the actual revenue generated over the last year, not some future projection, their revenue growth is sitting at an astonishing 1,732.08%.
Which sounds completely absurd on the surface.
Right, like a typo.
Yeah, but you have to contextualize that hypergrowth. They are actively transitioning from a pre-revenue research and development firm into true commercialization. Because their absolute revenue base was practically zero just a couple of years ago, any new revenue creates a massive percentage spike.
Ah, right, the base effect.
Exactly. But the size of that jump proves the transition is actually happening. They are proving the concept in the real world. And honestly, the most compelling data point hidden in that growth is their gross margin, which is currently sitting at 44.41%.
Wait, really? A 44% margin on early service testing? That is surprisingly high.
Yeah, it is.
Usually when a tech company is trying to prove a radical new concept, they practically give the technology away for free just to get users on board, to prove it works.
Just to build a user base, yeah.
The fact that they have a 44% gross margin tells me that the massive partners they are working with, companies like AT&T, aren't just humoring them. They are paying real substantial money for this testing phase because they actually value the data and the service.
It absolutely validates the underlying unit economics. The service they provide has genuine, monetizable value right now.
I see the value, but I gotta play devil's advocate here for a minute. A healthy gross margin is fantastic, but when you scroll down the balance sheet to the net margin, it is a painful negative 573.67%.
Yeah, that is the hard part to swallow.
Plus, there is zero free cash flow. They are burning through cash at a blistering pace. So you might be thinking, how can a company losing over 500% make any mathematical sense for an investor?
Well, the mechanism behind that massive cash burn is the brutal reality of the aerospace industry. Space technology requires what we call front-loaded capital expenditure, or CapEx. You cannot build a space network gradually.
Right, you can't just launch half a satellite.
Exactly. You have to design the satellites, construct them in these expensive clean rooms, integrate complex phased array antennas, secure highly volatile rocket launches, and blast heavy payloads into orbit before you can service a single paying customer at scale.
It's all up front.
That negative 573% net margin is simply the reflection of the massive operating losses required just to get the constellation into the sky.
So going back to our skyscraper metaphor, the infrastructure has to be virtually 100% complete, hanging there in orbit, before the recurring revenue can finally start flowing in to turn the financial ship around.
Yes, but once that infrastructure is in place, we really need to understand how AST SpaceMobile actually operates, because they possess a massive B2B competitive moat that often gets overlooked. Everyone immediately compares them to SpaceX's Starlink.
Right, the obvious comparison.
But their technological and business mechanisms are entirely different. Starlink fights for the end user. If you want Starlink, you have to buy their proprietary hardware, that physical dish you mount on your roof, and you pay Starlink directly.
Which creates massive friction for the consumer. Nobody wants to carry around a satellite dish in their backpack.
Exactly.
And this is where AST SpaceMobile's approach is brilliant. They aren't trying to steal you away from your current phone plan. They partner directly with the major mobile network operators like AT&T and Verizon, and the technology itself is what makes this possible.
Yeah, the direct-to-device angle.
Right. Instead of requiring a dish, AST satellites use these massive phased array antennas that unfold in space, and they act like giant magnifying glasses for radio waves. They beam the signal directly to your existing, completely unmodified smartphone.
And that changes the entire business model. AST SpaceMobile integrates directly into the telecom carrier's existing billing systems. So when you lose coverage on a road trip, your phone simply switches to the space network, and AT&T handles the billing.
It's seamless for the user.
Totally. By doing this, they bypass hardware disputes and consumer marketing entirely. They're essentially renting their space towers to the giants who already own the customer.
They own the highway instead of trying to build and sell the cars.
That's a great way to put it.
And that creates incredibly high switching costs. Once Verizon or AT&T bakes AST's space coverage into their premium cellular plans, it becomes technically and financially really painful for them to rip that integration out and switch to a competitor.
The business model is remarkably sticky.
Extremely. And the broader market is definitely taking notice of this potential. Even prominent voices like Jim Cramer recently pointed out that the company could achieve profitability within 2 years.
Which a 2-year timeline to profitability is incredibly aggressive in the aerospace sector, meaning the clock is ticking loudly. There are massive hurdles they have to clear in a very short window, and that timeline is entirely dictated by physical catalysts.
Yeah, let's talk about what actually moves the needle next. If the technology works, but the vision requires massive capital, the events that alter their financial reality are paramount. The most immediate checkpoints for you to watch will be the upcoming Q2 and Q3 2026 earnings reports.
But we should be clear about what to look for there.
Good point. Investors aren't expecting massive surprise profit jumps in those calls. They're looking for subtle updates on the commercial rollout timelines and any new revenue guidance stemming from those mobile network operator partnerships.
Right. While the earnings calls dictate the financial narrative, the single biggest physical catalyst, the event that truly changes the trajectory of the company, is the upcoming Blue Origin launch window for their next batch of Bluebird satellites.
Because if those satellites suffer a launch anomaly or just, sit on the ground due to delays, the entire recurring revenue model is basically frozen in place.
A successful Blue Origin launch is the absolute linchpin. It takes the market's focus entirely away from that terrifying cash burn metric and firmly pivots it toward revenue generation. It visually proves to the market that the execution phase is actually succeeding.
Beyond their own launches, though, I think you have to look at the broader macro environment because the aerospace sector as a whole is catching some massive tailwinds right now.
Oh, absolutely.
You have rising geopolitical tensions, specifically the ongoing conflicts in the Middle East, which are acutely highlighting the need for resilient, space-based communication networks that cannot be severed by ground combat.
Right. The defense application is huge.
Yeah. And additionally, the upcoming Artemis II mission is bringing lunar exploration back to the front pages of newspapers, which historically creates this halo effect, buoying capital flows into all aerospace equities.
Those macro trends create a favorable current, definitely. But the most fascinating sector trend right now is the massive appetite for consolidation. We recently saw Rocket Lab execute an $8 billion buyout of Iridium.
That is a staggering signal to the market. It proves that the biggest players in aerospace want to own the entire vertical stack, from the rockets that launch the hardware, to the satellites, to the communication networks themselves.
It's all about vertical integration.
And when you look at AST SpaceMobile through that lens of consolidation, they possess something incredibly unique. Highly valuable spectrum assets. Spectrum in space is basically finite real estate.
Right, there's only so much of it.
There are only so many frequencies you can use to beam data back to Earth without causing interference. If capital ever gets too tight for AST to finish birding their constellation independently, those finite spectrum assets, combined with their entrenched AT&T and Verizon carrier partnerships, make them a highly attractive acquisition target for a larger aerospace prime or a major telecom trying to vertically integrate.
So we've established the business plan and the physical catalysts, but we really need to examine what happens when all of this theory hits the actual trading floor. Let's look at the price structure, because right now, the chart is telling a very specific story of consolidation and mean reversion.
Yeah, the stock is currently sitting at $67.58. That is down over 7% just from the previous close. And as we mentioned earlier, it is down a staggering amount from that 123 three-peak peak. If you've been holding the stock, that drop feels pretty chaotic.
It feels chaotic, yes, but structurally, it has experienced significant mean reversion. To visualize that, think of a rubber band. The stock price was stretched incredibly fast and far away from its historical average up to $133.
Right.
Now, the tension is snapped, and the price is rapidly pulling back toward a more sustainable middle ground. Over the last 13 weeks, we've seen a defined multi-week correction phase where the stock is down about 26%. So we are well off the euphoric highs, currently testing lower support levels.
But if you are looking at the chart wondering where the bleeding stops, there is a crucial detail hidden in the data, the trading volume.
Yes, this is key.
The 10-day average volume multiplier is only 0.81x relative to its prior 3-month average. Simply put, over the last 10 days, the number of shares actually changing hands has dropped by roughly 20% compared to the historical average. The trading volume has significantly dried up during this downward slide.
And why does shrinking volume matter so much during a sell-off?
Well, because it tells you about the conviction of the sellers. Think of a massive, heavy boulder rolling down a steep hill. When a stock plummets on massive volume, it means institutions are actively pushing that boulder down the cliff. They're aggressively dumping millions of shares.
Right.
But when a stock slides downward on low volume, the hill is flattening out. The aggressive institutional selling pressure is exhausted. The motivated sellers have already left the building.
It's just gravity at that point.
Exactly. The stock is just slowly drifting lower simply because there aren't enough new buyers stepping in yet to catch it. The momentum is draining. And managing these volatile, low-volume drifts, trying to identify where the floor actually lies, is exactly why having clean, objective chart workflows is so vital.
Which brings us back to...
Yeah, exactly. It's why tools that visually highlight historical support and resistance zones, like VIP Algos does, can be so helpful. It allows you to plan your risk parameters based on data, rather than just guessing where the boulder will finally stop rolling.
So the technical chart shows the selling momentum is running out of steam. But the human element, the actual market sentiment driving this stock, is completely fractured. It's the ultimate battleground stock right now.
It really is.
If you look at the media narrative, it's totally bifurcated. On the bearish side, you have seasoned analysts explicitly stating that the stock has lost touch with reality. They argue the valuation is absurd, pointing to the fact that space stocks as an entire sector have tumbled 20% in just a single month, regardless of individual company fundamentals.
Yeah, the sector rotation away from speculative tech has been brutal.
It has.
And it is easy to get spooked by those headlines. But then you look past the media and analyze what the people inside the company are actually doing with their own money. The squeeze watch data completely flips that bearish script.
Insider buying is wild.
It really is. Over the last 90 days, we've seen massive, clustered insider buying. Corporate insiders have purchased a net 1,004,608 shares across 9 separate transactions.
And we need to make a critical distinction here. Corporate executives receive stock options all the time as part of their automated compensation packages. But that is not what this is.
Right.
This is open market buying. Management and board members are taking their own personal capital and buying the stock on the open market.
Over 1 million shares bought with their own cash in just 3 months. That signals absolute unwavering conviction. They clearly believe that this current $60 to $70 trading range is significantly undervalued relative to the commercialization milestones they see coming up internally.
They have the inside view.
They know the data from the AT&T tests, they know the Blue Origin timeline, and they are putting their money where their mouth is ahead of these launches.
That insider confidence is certainly infectious. But, 1 million shares bought by executives doesn't change the laws of physics or the brutal realities of the aerospace industry. We have to address the downside risks.
We absolutely do, because the risks here are substantial. The primary threat hanging over any AST investor right now is extreme shareholder dilution. We talked about that massive CapEx burn required to finish the Bluebird satellite constellation. Rockets are incredibly expensive.
Yeah, they don't launch for free.
Right. If their current cash reserves run dry before they can flip the switch on that recurring telecom revenue, they will be forced to raise more capital. Let's translate what that means for you. If you own a slice of pizza, representing your shares in the company, and AST needs to raise $1 billion to launch a rocket, they might issue millions of new shares to get that cash.
So they essentially slice that same pizza into 100 pieces instead of 8.
Exactly. The pizza didn't get any bigger, but your individual slice suddenly got much, much smaller. That is the textbook definition of capital constraint risk.
Alongside the financial dilution, there is severe execution risk. Their entire revenue timeline is reliant on external partners. They're entirely at the mercy of Blue Origin's launch timetable.
Which they don't control.
Exactly. If Blue Origin experiences an engineering setback, a weather delay, or a regulatory hurdle, AST SpaceMobile satellites stay on the ground. Their timeline to profitability gets pushed back, but their daily cash burn rate stays exactly the same.
Ouch.
Furthermore, you cannot ignore the ever-looming shadow of Starlink's massive expansion. Even though AST has that brilliant B2B carrier moat, Starlink has vast resources and is moving incredibly fast. Any breakthrough in Starlink's technology that allows them to seamlessly bypass hardware requirements could suddenly threaten AST's target market share.
Those are undeniable threats. However, to counterbalance that terrifying dilution risk, you have to look at the sheer scale of the company today. AST SpaceMobile currently holds a $26.02 billion market cap. Now, a $26 billion valuation for a company with negative net margins sounds widely overvalued.
It does, but ironically, that massive market cap acts as a profound equity cushion for current investors. Because their overall valuation is so incredibly high, if they do hit a wall and need to raise capital to fund those final Bluebird launches, they have to issue far fewer new shares to raise $1 billion than they would if their market cap was only $2 or $3 billion.
Going back to your pizza analogy, because the entire pie is valued so highly, they only have to slice off a tiny sliver to get the cash they need.
Exactly. The high valuation actually protects early investors from the most toxic, destructive forms of dilution. It provides management with the immense financial leverage required to actually finish building the network.
So with the revolutionary technology, the massive cash burn, the insider buying, and the execution risks all laid out on the table, what is the final verdict?
Well, based on our comprehensive analysis of the fundamentals, the catalyst, and the technical structure, we're delivering a bullish score of 7 out of 10 for AST SpaceMobile.
7 out of 10.
Yes. We view this favorably, but we want to frame this rating very carefully for you. This remains a highly speculative, long-duration opportunity. The entire core thesis relies on the successful deployment of their upcoming satellites. They must bridge that perilous gap from massive daily cash burn to highly profitable, recurring revenue generation.
Right.
The 1,700% revenue growth and the direct, sticky partnerships with major carriers like AT&T prove the business model works in reality, but the physical execution risk of getting the hardware into space remains a massive hurdle.
And we want to make it explicitly clear that this is strictly an educational analysis, is not financial advice. We're not telling anyone to buy, sell, or hold this stock. Your capital is your responsibility. And if you want a cleaner, more objective way to read trading charts while you manage that risk, check out VIP Algos through the link below in the description.
It's a great tool.
It is. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make charts easier to scan and understand, but remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it guarantees zero results. Trading inherently involves risk, so always do your own research and manage your risk carefully. Again, this is an affiliate link, and we may earn a commission at no extra cost to you.
And if today's talk helped you understand the mechanics behind the market, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
But before we go, think back to that impossible skyscraper being built from orbit down to the ground. It requires an insane amount of capital, precision engineering, and financial risk just to get the foundation to finally touch